So I'm very, very focused on first and second base hits over and over again, and compound that growth, and never swing for the fences. And just focus on consistency. That's what I focus on.
Welcome back to the Angels, Exits, and Acquisitions podcast. I am your host, Jeff Barnes, and today we're talking with Chris Vermeulen about technical trading and how to generate wealth long-term in an up market, a sideways market, or a down market using some pretty, he says, boring strategies. But let's face it, if you're making money, is it really that boring? So take a listen, watch this, give us a like and subscribe, and make sure you check out the show notes later on so you can learn a little bit more about technical traders. Thanks.
Welcome to Angels, Exits, and Acquisitions, the place to learn how to fund, scale, exit, and massively profit as an angel investor or entrepreneur. Brought to you by the Angel Investors Network. And now, here's your host, Jeff Barnes.
All right, welcome back to another episode of Angels, Exits, and Acquisitions. I'm your host, Jeff Barnes. I'm here today with Chris Vermeulen. Chris, how are you doing today?
I'm good, Jeff. How are you? Thanks for having me.
Absolutely. Excited to have you here on this conversation, this podcast today. We're going to be talking about your company, Technical Traders, and what you guys do over there to help people, generate wealth long term. I really have enjoyed learning a little bit more about you and seeing what you guys are putting out there. But before we dive into all of that, why don't you tell folks a little bit about yourself and how you got to where you are today?
Yeah, so a really high level is I got into finance in finance class, and we had a stock market challenge when I was 16 years old, and we made like $170,000, $80,000 in a semester. And I thought, hey, that's not a bad way to make money. And that kind of got me hooked. And my dad got a package in the mail from Larry Williams, who's kind of like the godfather of futures trading. And I read this little marketing booklet, and that even got me more excited that I could make 50 grand a week in pork belly trading and all of that stuff, which I didn't do. My dad, was like, no, you just learn about the markets. But I grew up in the country with no TV. And so I was always building and inventing and hunting and doing all that stuff. And so when I went to college in Toronto, I had a TV with cable, and I got hooked on two stations, which one was Speed Vision, which I don't even think is around anymore. And the second one was CNBC. And I saw people making money on the stock market every day. And I thought, okay, now not only did we do it in high school, but I was drooling to see these people making money every day. And I decided, hey, I'm going to learn to trade. I'm going to share my trades with others, and we'll learn and share our trades and build a community and build a business around it so I can do what I like, which is trading stocks. And my very first stock that I traded was Palm Pilot. And I turned a $2,000 account into $8,000 in a week when I was on holidays. So that was kind of like, enough to get you hooked for life with your first trade.
Absolutely.
At, 18 years old with a $6,000 profit in a week. And then from there, I ended up doing all kinds of different trading, from trading covered calls to options to futures to day trading, scalping, you name it. I've done a lot of different strategies, and I've come full circle to how can we make the most money from the markets, stocks, bonds, and currencies, with the fewest amount of trades, and manage large amounts of money, millions of dollars. You simply navigate and protect ourselves so we can make money in a rising market, a sideways market, a falling market. And that has kind of brought me full circle to where we are, technical traders, where I used to be a fundamental trader. Now we just focus on the technicals, meaning chart patterns, momentum, sentiment, money flows. We follow price. We don't predict. We don't really care where it's going. We just want to know which way it's going and how strong that trend is for different assets. And we hop on those and trade them. So in a nutshell, I've just become an ETF trader. We buy the indexes or bonds or a currency or sit in cash, and we just navigate our entire portfolio in those four major asset classes. And that's kind of full circle of like how I kind of got here. And that's where I focus all my time.
Awesome. No, I appreciate that overview. So it's kind of funny. When I was a kid, my dad was listening to these tapes. I think his name was Ken Roberts, if I'm not mistaken.
Yep.
And he would get these big booklets that would come like every week. And it was like learning how to do futures trading and all that sort of stuff. And unlike you, I didn't like leapfrog right into this. All I wanted to do was play baseball. So I didn't really understand what my dad was doing. I wish I would have paid a lot more attention when we're, driving on these long road trips and listening to these tapes, because there was a lot of explanation, a lot of information there. And I think for me, it was just like I didn't really dive into it because I didn't understand it well enough, mostly because I wasn't paying attention. But it's pretty cool when you have somebody who's kind of helping you with that, and then you fall in love with it, right? And you get that quick win. I think if you would have lost a lot of money, who knows? Maybe it would have been different. But to get a quick
Yeah.
win that nice that early, that can
Yeah.
definitely help cement some ideas as to where you want to go with this, right?
Yeah. Yeah. I did lose all my money in the tech bubble. I blew up 3 trading accounts, 1 futures account. The last one that I blew up, the day I opened it and funded it was the same day I blew it up. And so I have taken a lot of big losses. And
Sure.
through those are how you actually learn to become a good trader. Eventually you hit the breaking point of like, I give up. Or if you're like me, you're like, I'm not giving up. I'm gonna figure this out. And it comes down to you need rules and systems and self-discipline.
Yeah.
That's a big part of pretty much success across the board is having self-discipline and the drive.
Yeah, that's one thing I found with most successful people in almost any area of life is that
Mhm.
they don't let emotion dictate their actions, right?
Yeah.
They're not reactionary to whatever's happening in the world. I mean, you can look at Warren Buffett or Ray Dalio or any successful entrepreneur. It's like, yeah, there's emotion in getting into it, but then they create their processes, right? They create their risk mitigation, risk management practices and say, we're sticking to this, come hell or high water, this is what we stick to, right? So talk to us a little bit about how maybe that's led you astray in the beginning, and if it did, it sounds like it might have a little bit. And then how you decided to develop these disciplines around the risk management aspect of this.
Yeah, so there's a lot that happened to bring me full circle to where I am. I'm very, very much so managing risk, all about managing positions. I got my POTS license when I was 16 years old. So I'm a big fan of checklists and rules. If just no matter what happens, just follow the checklist and you should be back on that ground safe and sound. That's kind of the pilot thing. I know a lot of my subscribers are investors they're pilots. We just have a very logical mind and we cut emotions out. So if the wing chunk is flapping, you look out the window, most people would panic and go, we're going to die. And a pilot's just like, all right, this is what we do. And we're going to land. The plane can still fly with a ton of damage. It doesn't mean it's like, over. So I apply rules and checklists to the strategies, but I didn't really do that until after I blew up all my accounts and hit a breaking point where I'm like, holy crap, I need to change something significantly or I'm going to lose my mind. And it was pretty sobering. Once you lose all your money, especially when you do it the same day, for the same reason you blew up your previous one, which was day trading futures, averaging down into a position, thinking it'll eventually turn around. Super dangerous. So I like checklists. I like rules. My Myers-Briggs personality is an INTJ. So I'm like known as the scientist or architect. So the stock market actually is all about logic and rules and very scientific. So it fits perfectly with how I function. But I had to get over the emotional side that you just stated there. And that's the part that kills everyone. And to get over your emotions, you need to understand how dangerous they are. You need to understand when you're being affected by them. And you need to eventually put rules in place that it doesn't matter how you feel, you just have to execute and follow the plan. And if you do that enough times, eventually the plan becomes very comfortable and you're like, I hope this works out, this particular trade, but I'm following the strategy. I feel nervous, but you can overcome that fear. And all I know is, my father did very well. He retired in his early 40s and had a very good lifestyle growing up, but he got into the wrong investment after he retired. And it ended up blowing up and we went bankrupt. And we went from the top of the food chain to the bottom. We had nothing but furniture and a rental property at that point. And it was pretty devastating. And during that process, one morning I heard my sister screaming. I heard my mom screaming. I come running over and my father's laying there having seizures. We had no idea. We thought he was dying. I remember my sister looked at me and she mouthed, she's like, Dad's dying. And
Wow.
it was the scariest moment of my life. We've never experienced it before. And it was because of financial stress and of losing all your money and losing, your investors' capital, who are a lot of them were friends and family. And so that experience was so severe. It definitely was trauma in my life. And now I'm like, how do I avoid ever having that happen? So I'm very, very focused on first and second base hits over and over again and compound that growth and never swing for the fences and just focus on consistency. That's what I focus on. And so that's where I slowly evolved, and all that happened kind of after I'd blown up my trading accounts. And that was kind of the final straw. I'm like, okay, it's so serious you can almost die if you lose too much money. It's that emotional. And so that was the real kind of turning point where I'm like, I am just going to be super boring and bone and dry, make strategies and follow things and not hunt for trades. I'm just going to wait for the trades to come to me. And the best analogy, I think, for people to understand how the financial systems work is like the stock market is, it's like the ocean. When the tide goes up, it lifts all boats. When it goes down, they all go down. The stock market is the same. If you're in a bullish, rising market environment, you want to hold stocks. If the stock market is going sideways or down, you don't want to hold stocks. You want to go to a different asset that is going up. It could be bonds. It could be a currency, something that has lower volatility while the stock market is being wild, but that is still going up. And so that's where my whole strategy kind of comes around, and is all about identifying these waves. Usually there's 5 to 12 waves that roll through the market every year. So I consider myself kind of like, I am a surfer, but I picture yourself floating out past the break on a beach. Those surfers are waiting for that next set of waves. And every year the stock market has 5 to 12 waves. You can see them coming. We can gauge the strength. When it's an asset that we know inside and out and that fits our criteria, we're like, all right, let's hop on this. The nice thing about catching these strong waves is you also know when they're starting to weaken. So you can be like, all right, let's start trimming some profits. Let's start moving our protective stops up in case it rolls over. We're mentally prepared that it is coming to an end. And when you ride these swells in the market, these waves, it really removes a lot of stress because, first of all, you see them coming, you get on them, you see them weakening, and they're not like these news-driven moves and stocks popping and dropping and all that crap that people get sucked up in, and really take all your time. So the strategy I focus on is 5 to 12 trades a year. We don't need to do anything. We don't need to look at the charts through the day. It's all end of day data. And we're just trying to grow our entire portfolio with a couple ETF positions at a time. Very, very simple and straightforward. And it's all based on rules and systems that gauge price action and momentum.
So you said a lot there. First off, how old were you when your dad went through that experience?
I think I was... I don't remember exactly what age I was. I was either early 20s or I think it might have been early 20s. I don't know. It's funny. I was thinking of that the other day. I'm like, when exactly was that? But it was early on. I had my pilot's license. Yeah. But it definitely was my trauma to focus on. It was early 20s because I had already blown up a couple of accounts. The tech bubble had already topped and everything just kept falling. Even if I bought the strongest companies growing quarter after quarter, fundamentally, the stock prices kept falling 50% and then another 50% from there. And that was what broke. That was what I was like, fundamental data to me is garbage. I'm like, even though it's the strongest company in the stock market growing the most quarterly, it is still getting the stock price going down 50 to 80%. I was like, there has to be a better way. And that was when I stumbled across technical analysis. I'm like, you know what, let's just focus on the trend and how strong it is. And if it's going down, let's get out of it. Let's not hold it, or let's benefit from it falling at least. And that was the game changer. Now it's not about trying to pick tops or bottoms. Now it's like, find an asset, wait till it's in a new trend. We never get in anywhere near a bottom because it takes a long time for a new trend to turn up and then to confirm that, hey, this is a trend. And then same when we get out, it'll top out, it'll pull back quite a bit before the trend is technically ended and we get out. And really we just get to catch that simple middle section of the wave, which is the low risk kind of part. And it's really boring. It's like watching paint dry, but when you make money every year in a falling market included, it becomes pretty fun. And it's a life-changing scenario for most people.
Before continuing, please subscribe and share this video to help us reach more people and stay notified of our latest releases. Now, let's continue watching and learning.
Yeah, no, absolutely. And I'd say, watching your dad go through that, I had a similar situation, not maybe quite as severe, but my dad lost his business and I got to witness that. And it was really rough to watch that happen to the whole family and same very similar circumstances. You see that and it definitely gels, especially in a young man's mind as to, geez, I imagine you probably went through this similar situation. Like my dad was way up here on the totem pole as far as I was concerned. Like coolest dude, toughest, everything. And then to watch this kind of thing happen, you're like, holy moly, he's human. And that really does have an impact on every young man if they witness something like that, and shapes a lot of their decision-making processes going forward. And so for you, in your case, it was, all right, let's start learning about this whole risk mitigation strategy and, understanding the difference between value investing and technical investing. And like you said, there's, I think it was Ben Graham, the education of a value investor, right? Talked about all this sort of stuff. And that, over the course of 40 years, you can average 12% is what they tell everybody. Never mind all the fees that come along with that, that erode your wealth over time, as well as, all the ups and downs along the way that I think give people heart palpitations, right?
Yeah.
And so understanding that about yourself early on, that's a pretty powerful gift, even though it may not look like that. I think that's what you could look at as a really powerful gift to shift your mindset. And so for the folks that are listening to this that may not be really clear on what value investing is and technical investing is, and what even the difference is between commodities and what futures are and ETFs. Can you give some broad brushstrokes around those topics, and then we can go into the difference between value and technical investing?
Sure. Yeah. So when I say the equities markets, that is the stock market. Equities are stocks. And so what I focus on are the indexes, which is you really hold the whole basket of stocks. And so we just want to know if the tide is going up. If most stocks are going up, we want to hold that basket. And so that's to me, this is where I really differ from a lot of people. So a lot of people will look at the equities market stocks and be like, oh, I'm diversified. I own sectors and dividend stocks and energy and biotech and technology, and they're all diversified and they think they have this protection. But the problem is they have all these really volatile, independent sectors and stocks. And when the tide goes down, they actually fall more than the indexes. So the more you diversify, the more risk you're actually adding. You're just adding the same asset, but the more volatile ones within that portfolio. And so I don't believe in doing that. And so that's the equity side, is just know when it's a rising tide or falling tide environment, hold equities, which through an index ETF, it's super simple, or don't, one or the other. The other one is currency. You might want to hold the US dollar. If the economy becomes weak and there's a financial reset, we tend to see the US dollar move dramatically higher. And so holding dollars is a very good thing. I'm Canadian, so for us to move our money to American dollars and watch it go up 20, 30, 40% is a big opportunity. And then eventually, if the dollar or currency isn't good, then you might want to just move to potentially a bond position. Bonds can go up while the stock market goes down, depending on what interest rates are doing. So there's these different asset classes: stocks, bonds, and currency, and then cash. Those are the four biggest markets there are. You hold one or most people have a big mix of those. And I focus generally on holding just one at a time. And once that asset has stopped that giant move to the upside, then we rotate into the next one, or potentially just holding cash until there is another wave. Sometimes there isn't a wave for a little while. But that's kind of it from a really high level in terms of what those are. Then you were talking about what technical analysis is. Technical analysis is following the price charts. There's bullish patterns that form on a chart that if a certain pattern forms, it'll project where that price should run to and how long it should take to get there, roughly. And so we can gauge, is the trend up or down? If the trend is up, we're looking for bullish chart patterns. And then we can use tools, technical tools, to kind of forecast where that price should potentially run to. And that's the nice thing about technicals is it doesn't matter what the economy's doing. All we're doing is following the trend of the stock or the commodity or whatever it is that we're trading. And we follow price action. And when charts draw, it's called painting a chart. So I always say, we got to let the charts paint us a nice picture. When they paint us a picture we like, we can invest into it. And that's what we focus on. I didn't mention commodities, but commodities are lumber, it's gold, it's coffee, it's all these different things. They trade in the futures market, which is highly leveraged. Big institutions usually trade futures companies to buy their commodities in bulk, large orders. And commodities are generally, most people would never really touch or trade them. You can trade a small amount of money on them, which like a $1,500 position on the SP 500 futures, which is the index fund. You're really managing like $200,000 or $300,000 with a $1,500 investment. So on a bad day, if you catch the wrong side, that $1,500 position you put on can be wiped out and lost, and you can lose like 5 or 10 or 20,000 potentially on a big wipeout day. There's a lot of leverage to futures. So I highly recommend people don't touch futures. That's how I blew up my accounts.
Yeah.
You don't need leverage to make a lot of money. You need consistency, and you need to compound your growth. You don't need to add leverage. It's a dangerous knife there.
Yeah, I mean, especially when you're just getting in, and if you're trying to do it yourself and you're trying to learn this thing, you know, better to lose your own money, in my opinion, than lose your money plus whatever margin you have on top of that, and
Exactly.
and risk going even further negative, right?
Yeah.
I think that's, if I'm not mistaken, that's how this thing called the Depression started, quite a
Yeah.
while ago. We had a lot of that kind of stuff happening, right?
Yeah.
So yeah, very very good advice. So when it comes to what you guys do, are you guys managing other people's money? Are you just educating people? Do you have funds that you guys do this, or is it really just your own money that you guys are really putting in?
Yeah, so Technical Traders really it's a newsletter business, meaning you pay an annual subscription fee, just a flat fee, and more or less I provide videos of what the market's doing a couple times a week, and I share exactly what I'm doing with my portfolio. So I say, hey, I'm buying SPY ETF with 50% of my portfolio tomorrow at the open. Um, and I provide my protective stop. I tell you where my target is, how much we're going to sell at the first target. So more or less, people just are accessing. I manage my money. I follow the markets, manage my money, and everybody just kind of rides my coattails. You just copy what I do. And we have auto trading. So if somebody doesn't want to learn or watch anything, it can be executed in someone's account automatically. We don't manage money. They just work with an independent broker that automatically trades our signals. And I know we do have advisors who offer the asset revesting strategy. So if somebody still wants to be with an advisor and have this strategy deployed with some or all of their capital, they can have an advisor do that as well. So we don't manage money. All I do is I share my insight, my research, and people just copy what I do.
Okay, very cool. That's helpful to understand. So when it comes to getting into this kind of trading, right? Like obviously people have to have their own money. What's the time commitment that somebody has to consider making if they're going to say, hey, I want to go start learning this whole technical trading thing, and I want to start, like you mentioned, there's auto trading, but let's just say they want to do it themselves. What kind of time commitment would people be looking at to really get the feel of this and understand what they need to do?
Um, for just following the asset revesting strategies, I do a Monday video and a Wednesday video. They're just education. They just kind of update you, show you what's going on in the market, why things are moving, what to expect over the next few days. We kind of look at the bigger picture. It's really just there to kind of hold your hand and let people understand what's going on, so their emotions aren't flying with all the crazy news and tariff stuff going on. We don't need to get all worked up. We just look at the price. So if you have half an hour a week, each video is usually 8 to 15 minutes. And it's just enough to give you a recap. I'm like, okay, this is what's going on from a technical standpoint in the markets. Again, we only have 5 to 12 trades a year. So when we do have a trade, we'll send out a trade alert. It'll also go through our mobile app if you have that. And it'll say, trade alert, action required. And you just follow that trade, meaning it'll say what to buy. And you would just log into your brokerage account. You'd put in the order to buy with however much money you're interested in doing, and place the order. And that's it. I mean, if you don't even want to watch the videos, you just wait for a trade alert. And there's 5 to 12 of them a year. So it doesn't require much time. Half an hour a week if you want to be updated. Other than that, just wait for the odd email, a couple emails a month, just to say, hey, here's our trade, or we're adjusting our trade, we're tightening our stop, or we've hit a target. Let's close some of this position out. So it doesn't require much at all. And you don't need to be near the computers or anything. It's all end of day, meaning we don't get any triggers until the markets close. We send out an evening update, so you have all night and all morning to see it and take action if you need to. So it's pretty laid back. I mean, if somebody wants to, they can take our other package, which is like a daily video, so you can really get into the nitty gritty every day. But you really don't need, if you're an investor and you just want to grow your capital and not mess around with the markets, you just want to be educated and put on the trades. Yeah, half an hour a week, broken up, Monday and Wednesday nights.
Gotcha. So I know you're not an advisor, and we got to always be careful our disclaimers. You're not giving advice here, and they have to talk to their own advisors when they're doing this stuff. But what kind of returns do you say people should maybe not hope for, expect, or historical returns, because I know we can't predict the future, right? But when somebody's saying, okay, well, I need to start managing a portfolio, whether they're starting with 10,000, 100,000, $1 million, we all know that, putting money in investments is much better than just putting it in a CD or the bank, right? So what is it that people need to think about or expect when it comes to either A, how much capital they should begin with out of their overall nest egg, and B, what kind of returns do you guys generally tell people to expect?
Yeah, I mean, our average return historically is about 14%. So 14% a year. Some years are bigger, some years are 20, 30, 50 plus percent. Other years are like 5%, 8%. It really varies on how the market moves.
Mhm.
So that's as you know, nothing is consistent, the market. So you're going to always have good and not so good years. So that's kind of what we shoot for. That's just what our strategy averages over time. For example, like a big divergence, like some people are like, well, 2022, you only made 5.5%, and which isn't much. But when you look at what the buy and hold portfolio did, which was down about 25%, I mean, we're looking at a 30% spread. We actually made money. It's huge. And people sometimes just don't realize that. Um, it's not about how much you make. It's about how much you're not losing if you were to do other strategies, right? That's where this strategy is very protective. So, for example, the buy and hold strategy, the 60-40 stock bond portfolio, can have about a 40% drawdown during financial resets. The tech bubble, 2008, it was about in 30% or so during COVID. Our strategy that we use, because we're only holding assets going up or we're sitting in cash earning interest, our max loss or max drawdown through our worst streak was less than 6%. So it
Wow.
shows like how low our volatility is. And we're just constantly going for those first, second base hits. And then it's when you make that money, the next trade, because we have 5 to 12 a year, you're compounding that growth. That growth you just made on the last trade is rolled into the next trade and rolled into the next trade. So we're growing our percentage return on top of the previous growth. And that gives us that compounding, which Albert Einstein says is the strongest force in the universe. And that's where we get the leverage without actually having the downside of leverage. So for example,
Right.
by compounding, we're growing on our growth. But when we have, like, say, a 5% correction in the market, it's only 5%. What people don't understand is they're like, oh, I want to make more. They go to a 2 leveraged ETF, which doubles that. And when it goes against them, they lose 10%. So we still kind of get that double upside, but we don't have the double downside because we're not leveraged in the same way. So compounding is so powerful. People don't fully grasp it, but it is, just it's so silent and so powerful, and it takes time to kind of show the value of it because you do need to compound, but it makes a massive difference, and that's where the value comes in, is compounding 5 to 12 times a year, your growth on growth on growth.
Right.
Okay, we can do it without big volatility and sweating when the stock market rolls over and worrying about how much am I going to lose or when do I get out. That's not what we do.
And I think that if I had one takeaway when it comes to any of this stuff, it goes back to Berkshire Hathaway, Warren Buffett's number one principle, which is don't lose the principle, right? Don't risk your principle because you can't compound nothing. It's a mathematical fallacy to be able to compound from zero, right? So it sounds like that's a lot of what you're saying, which is, listen, we have strategies in place to minimize the overall risk, minimize the downside, maximize the upside maybe, but really it's just to stay within certain parameters that are going to ensure that you're not, like you said, maybe you only make 5% in a year. And people would look at that, if they just look at that 1 year and they only look at year returns, it's a very myopic view, right? Because if you look at everything else, well, maybe it went down 20, 30%. I mean, I'd rather make 5 than lose 30. That's for sure.
Yeah, for sure. It's funny. Some people have very different mindsets, how their brain works. Some people can't wrap their head around some types of returns and things like that. But it's very powerful to preserve your capital and not lose it. Like that's the biggest thing, is just make sure you don't, when something turns down, there's no point in holding it. We're investors here. We're not buying stuff to go down. If it's going down, we should actually just get out of it, find something fresh, something that's going up.
Yep, absolutely. So, Chris, we're about to wrap up here, but before we do, I have one last question for you, which is, knowing what you know now, I've gone through this part of your career, and you're probably, it sounds like about the same age as your dad was now when he had his
Mhm.
issues, a couple decades ago. Going back to that young kid, if you could go back in time and give yourself one piece of advice, what would that be?
Well, there's so many different aspects. If it's for the stock market, it would probably be systemize, make rules. Um, yeah, it would be focus on technical analysis. There's 4 stages to the markets. Identify those, apply technical analysis, and manage those positions. From a business standpoint, because I have multiple different businesses, it would still be very similar. It'd be systemize the processes so you're not stuck in the business, and do something that you can get leverage on. So, for example, I record my video every morning. 15-minute video for members every morning. I record it once and I'm done, at 8:45 in the morning, but it goes out to thousands of users and I get paid for it thousands of times every day. So that is leverage. You can create a course and sell it. Once you've made it, you can sell it unlimited. So focus on systemizing something you have. Focus on I do what I love, which is great. I think I'm kind of going off. There's a lot of different stuff I would say. Do something you love that your brain works with, that you seem to have a knack at. And then find a way to monetize it and systemize it. And obviously, if you're going for money, I'm very kind of more money oriented when it comes to. I grew up in an entrepreneur family, so they've always been pushed to do my own business, my own landscaping, do it. Yeah.
No, I love that. And there are a lot of principles we'd love to go through, and narrowing it down to one is sometimes hard, but it is, right. But if you had that 5 minutes with your younger self and say, hey, here's what I really want you to focus on, I think it's really important when we think about that, because there's a lot of people listening to this that they don't know, and they are maybe in the throes of things right now, and there's always something going on in the world that can be negative or positive, but
For sure.
stay in the course, and like you said, learn the systems, learn the processes, and find a way to leverage that. I love that. So, Chris Vermeulen, thanks so much for being here on the Angels, Exits, and Acquisitions podcast. Where can people find a little bit more about you?
Sure. Yeah. They can find me on YouTube at The Technical Traders, or they can go to my website, thetechnicaltraders.com. And I've got a free newsletter there. I got videos of what I do, which will show you exactly how I cover the markets and why. And it should resonate with a lot of people. Very logical. Everything kind of makes sense. And I really kind of show how and why the markets move. And it's all available there to get a taste of what I do.
Beautiful. All right. Well, we will make sure we have all of that information inside the show notes. So if you're watching this or listening to this, make sure you check out those show notes and go look up Chris and thetechnicaltraders.com and learn a little bit more about this if you're interested in learning how to become a technical trader yourself. This has been the Angels, Exits, and Acquisitions podcast. I'm your host, Jeff Barnes. Chris, thanks so much for being here.
Thanks, Jeff.